Hello everyone and welcome once again to your very own channel Easy and Effortless Economics. In today's video we are going to discuss about accounting concepts. In the previous video we have already discussed about the accounting standards and I guess that must be clear to all, but still if you have any doubt you can just mail me or just let me know so I can revise the same. Okay, so now let's begin with today's lecture, that is accounting concepts. But before starting with the lecture, let's first understand what actually these concepts are and what is the role of these concepts, what are the objectives that these concepts are incorporated into the organizations. First and foremost, that you need to know that these concepts are defined as the rules, standards, assumptions, principles which provides the guideline, which provides the path for that help the organizations in maintaining the books of accounts and for carrying out the or recording the business transaction. So let's see what does it say. The term accounting concepts refers to the basic rules, assumptions and principles which act as a primary standard for recording business transactions and maintaining books of accounts. So for recording transactions and maintaining books of accounts, these accounting concepts are needed. Now comes that what is the objective of these concepts? Why these concepts are being used? Firstly, it provides a uniformity and regularity in the preparation of the accounts. So there's uniformity, a system is assigned and on the basis of that system the entire thing has to be done. Secondly, it helps the accountants in preparing and maintenance of the business records. And thirdly, it provides business rules and regulations. So ultimately, it provides a structure, it provides a format on which the organizations have to work and on the basis of which it can be determined that how the transactions has to be recorded. And these are incorporated by the organization so that there could be uniformity in every organization and in every books of account. Now let's have a look at various types of concepts. Let's begin with the first one, that is business entity concept. Business entity concept says that business and the owner are two different things. Basically, business and the owner are independent entities. They should not be confused as one. They should not be considered as one. They are completely different. For example, Mr. X has invested 1 lakh into the business for which out of which he bought machinery, raw material, so many things. But that all will be considered as a part of the business, not as the owner's thing. But when he took out suppose 50,000 from the business for his own interest, for his personal reasons, for personal work, that would be considered as the part of his personal belonging or personal transaction. So here you have seen the difference between the two, that the business and the owner are completely different. Second is your accrual concept. This concept means that if the amount is due, that has to be recorded in the books of account. For example, what happened that the organization has sold out some goods to some XYZ organization and they have not made the payment as yet, but still that has to be recorded in the books of account. So it says the term accrual means something is due, especially an amount of money, because here we are talking about money that is yet to be paid or received at the end of the accounting period. Whether it has been paid or it is yet to be received. It implies the revenues realized at the time of sale through cash or not, whereas expenses are recognized when they become payable, whether cash is paid or not. It means whether the amount is paid or not, the recording has to be done in the books of account. This says the accrual concept. Now coming to the third concept, that is the accounting costs concept. What does it say? It says that the accounting cost concept states that all the business assets should be written down in the book of accounts at the price assets are purchased, including the cost of acquisition and installation. The assets are not recorded at their market price. It implies that the fixed assets like plant and machinery, building furniture, etc. are recorded at their purchase price. Now, to make it more easy, it says that when you are recording an entry of an asset in the books of account, it has to consider every related cost. For example, the installation cost, suppose the machinery is purchased for 50,000, so there will be 20,000, sorry, 2,000 is the rent and 2,000 is the installation charges. So when the recording has to be made, it will be for 54,000, the machinery, the rent and the installation, and all this combinedly known as the historical cost. So this is the accounting cost concept. Then dual aspect, as the name says that every transaction has two aspects, means it affects both the side, the debit and the credit, and it has the effect on the assets and the liabilities. So it says this concept assumes that every transaction recorded in the books of accountants is based on dual concepts. This implies that the transaction that is recorded affects two accounts on their respective opposite sides. Hence, the transaction should be recorded at dual places. It implies that both aspects of the transaction should be recorded in the books of account. For example, purchase is made for cash, purchase of goods for cash 10,000. So there are two transactions: purchase, goods were received, and the cash were given. So two transactions, both the debit and the credit sides are affected. So here it says the duality of the transaction is commonly expressed in the terms of the following equation: assets is equal to liabilities plus capital. So it means that every transaction has a similar effect on the assets and liabilities. Then going concept. Going concept says that the business is not that easy to be dissolved. It's not that for a temporary period of time. The continuity of the business remains for a longer period of time. Once the investment has been done, it took for years to continue with the same. For example, machinery were purchased, it will be keep on being used in the organization. Whether new members will be coming, new people will be joining, but the business remains the same. So it says the going concept in accounting states that the business activities will be carried by any firm for an unlimited duration. Unlimited duration means indefinite period of time. This simply means that every business has continuity of life, hence it will not be dissolved shortly. Means every business has continuity of life. People may not be that consistent. We cannot continue with the business for a longer period of time or for any of the reasons, but the business keeps on going. As it says, the show must go on. So the business keeps on going irrespective of new entrants or whatever. Then money measurement. Everything that is dealt or every transaction that is done in the business has to be recorded in the books of account. It says a money measurement concept assumes that the business transactions are made in terms of money that is in the currency of a country. Suppose the transaction is going around in two countries, the recording has to be done in the currency of that particular country. For example, in India, transactions are made in terms of rupee and respectively. So every country has their own currency. So transactions are recorded in their respective currencies of the country. Then accounting period concept. There is a confusion about two types of period. One is the accounting period and other is the calendar period. Calendar period is the one that starts from 1st of January and ends on 31st of December. Accounting calendar, when we talk about accounting calendar, that is the one which starts from 1st April of this year to the 31st March of next year. So accounting period concept says that the balance sheet and the profit and loss account of a business should be prepared at regular intervals. This is important for different purposes like calculation of profit and loss, tax calculation, ascertaining financial positions, etc. Actually, this concept says that there should be regular intervals or regular preparation of the account so that everything can be easily identified that whether the company is running into losses or what expenses have to be done. This concept assumes that business indefinite life is divided into two parts. These parts are termed accounting periods. It can be 1 month, 3 months, 6 months, etc. Usually 1 month is considered as one accounting period, which may be a calendar year or a financial year. So it is up to the organization. Suppose if they want to record in terms of accounting year, basically that is for accounting transaction over the organization, they consider it only the accounting calendar, but for some of the reasons the organization can also opt for the regular calendar. So here for every transaction there has to be regular recording. It should be regular recording of the transaction. It can be for 1 month or 3 months or 6 months accordingly, so that the actual position can be easily identified. Then is the realization. The term realization concept states that revenue earned from any business transaction should be included in the accounting records only when it is realized. For example, if something has been sold or goods have been sold to such particular organization, that will not be recorded unless the amount that is required for that particular goods is received by the organization. In the accrual, what we have seen that the recording has to be done whether the amount has been received or not. In the realization, only it will be done when the amount has been received. The term realization implies that the creation of a legal right to receive money. Hence, it should be noted that selling goods is considered as realization, whereas receiving order is not considered as realization. Means order has been received, that will not be considered as a realization. The amount that is received will be considered as a realization. Then comes the matching concept. The matching concept states that revenue and expenditures incurred to earn the revenue must belong to the same accounting period. Hence, once revenue is realized, the next step is to assign the relevant accounting period. The amount that is generated or that is received by the companies has to be recorded in the proper books of account, should not be missed out on any ground. So that is the matching period, that once you have received, it has to be recorded. So these are the accounting concepts, and I guess these, by hearing this video, you will get the idea that what actually these concepts are. Though these concepts are not required at every step of your life, but still you should know as an account student or as a commerce student. At times when you are appearing for some of the exams, you find the questions around like what is going concern concept, what is business entity. So this is for your reference. So I guess this video will definitely help you all in understanding the concepts of this accounting. In the coming video, I'll take up accounting conventions, principles, and then we'll move ahead with the accounting equation, journal, ledger, and so on. So stay tuned, keep learning, keep smiling, and keep studying. Thank you everyone. God bless you all.